This is your Swap Hunt Daily News for March 6, 2026. A crypto research firm just shorted Ethereum publicly, pointing to Vitalik Buterin's own selling as a warning sign, while sanctions evasion via crypto surged 700% last year. Markets are under broad pressure today with sentiment deep in extreme fear. The total crypto market cap slid overnight as selling extended across major assets. Bitcoin is holding above recent lows but without conviction, and altcoins continue to underperform. The regime signal is technically bullish on the 12-hour chart, but price action and fund flows tell a more cautious story. Fear and greed sits at 18, a level that historically marks peak pessimism before repositioning begins. Culper Research has gone public with a short position on Ethereum and related securities. The firm cites two converging concerns: Vitalik Buterin's recent ETH sales and the aftermath of December's Fusaka upgrade. According to Culper, the L1 scaling changes introduced by Fusaka compressed gas fees far more aggressively than Ethereum's leadership anticipated. The firm claims validators and the core team overestimated market elasticity by 3 to 9 times, leading to a collapse in fee revenue that has hurt staking yields and validator economics. Lower yields, Culper argues, reduce demand for high-value on-chain activity, creating a structural headwind that's being masked by vanity metrics. The firm specifically refuted analyst Tom Lee's bullish thesis, asserting that most of the post-upgrade growth in active addresses was driven by low-value wallet dusting attacks enabled by cheaper block space. 95% of new wallet growth, Culper claims, came from newly created dusting wallets, accounting for over half of all ETH transactions. On Buterin's selling, Culper characterizes it as informed rather than routine treasury management, suggesting he understands the flaws in current ETH tokenomics better than the public narrative lets on. The broader competitive picture is also stark. Culper sees Ethereum losing ground to Solana and its own Layer 2 ecosystem simultaneously, a squeeze from below and within. Whether this short plays out depends heavily on whether ETF inflows can counteract the structural erosion Culper has identified. Kazakhstan's central bank has announced it will allocate $350 million worth of its gold and foreign exchange reserves into digital asset investments. The funds are earmarked for blockchain technology firms, tech-linked equities, and funds with exposure to digital assets, not a direct Bitcoin purchase, but a significant institutional pivot nonetheless. This makes Kazakhstan one of the first central banks in the world to formally redirect reserve capital into the crypto ecosystem. The timing is notable. Central banks globally have spent the last 2 years discussing digital asset frameworks while largely staying on the sidelines. Kazakhstan is moving from discussion to allocation. The country already has a developed crypto mining sector and has operated regulated digital asset exchanges since the early 2020s, so this isn't a cold start, it's a logical extension of existing infrastructure. For the broader market, central bank reserve diversification into digital assets carries a different weight than corporate treasury buys. It signals that sovereign risk managers, whose mandates are preservation first, see enough stability in the asset class to justify exposure. If other central banks in the region take note, this could mark the beginning of a new category of institutional inflow that analysts haven't fully priced into long-term models. Blockchain analytics firm Chainalysis has reported a 700% surge in crypto-based sanctions evasion tactics in 2025. Russia, Iran, and North Korea were the primary actors, collectively moving over $100 billion on-chain through a combination of stablecoins, hacked exchanges, and state-linked platforms. The scale is significant. This isn't fringe activity, it represents a systematic expansion of state-level financial infrastructure built specifically to circumvent international sanctions. Stablecoins played a central role, offering dollar-denominated value transfer outside the traditional banking system. The report will likely accelerate regulatory pressure on stablecoin issuers to implement more granular blacklisting and compliance tools. It also puts exchanges that lack robust sanctions screening directly in the crosshairs of enforcement agencies in both the US and EU. The data arrives at a sensitive moment. Policymakers are currently debating stablecoin legislation in several jurisdictions, and this kind of findings directly shapes how restrictive those frameworks will be. For compliant exchanges and issuers, tighter regulation could create competitive advantage. For the broader crypto market, the reputational and regulatory overhang is real and likely to persist as a headwind through at least the first half of the year. Ethereum ETFs just recorded their strongest single-day inflow since January, pulling in $169 million on Wednesday. That snapped a 5-week outflow streak that had drained these funds by nearly $1.4 billion. The rebound caught some analysts off guard given the broader bearish pressure on ETH's price. CoinShares analyst James Butterfield noted that recent client conversations have shifted from discussing how to reduce exposure to identifying entry points, a subtle but meaningful change in tone. Alex Kupcikevich of FX Pro described the ETF strength as a victory for crypto, suggesting institutional players are beginning to treat digital assets as a hedge rather than a pure risk on trade. The ETH price did rally sharply on the day of the inflows, touching a one-month high before pairing gains. Analyst Rec Capital flagged a critical technical level. ETH needs to reclaim a multi-year ascending trend line around 2196 on the monthly chart. Failure to hold that level would confirm a macro breakdown, with analysts pointing to a historical demand zone around 1600 as the next meaningful support. The inflow data and the Culper Research short are pulling in opposite directions, creating exactly the kind of two-sided tension that tends to define pivotal market moments. Morgan Stanley has filed for a spot Bitcoin ETF, selecting Coinbase Custody and BNY Mellon as custodians. This is a meaningful development for Bitcoin market structure. Unlike the initial wave of spot ETF launches in early 2024, which absorbed significant selling pressure from grayscale rotations, Morgan Stanley's entry is expected to represent net new demand. The bank's wealth management platform serves some of the largest retail and institutional accounts in the United States, meaning even modest allocation recommendations to clients could translate into substantial inflows. Analysts note that Morgan Stanley's ETF filing removes a key rotational headwind that muted early ETF performance. There's no legacy high-cost product to unwind here. Meanwhile, Bitwise Asset Management made a $233,000 contribution to open-source Bitcoin developers as part of its annual commitment to reinvest 10% of gross profit from its BTC ETF into the developer ecosystem. Recipients include Bitcoin Blick, OpenSats, and the Human Rights Foundation Bitcoin Development Fund. The combination of Morgan Stanley's distribution reach and Bitwise's developer support reflects two different but complementary bets on Bitcoin's long-term legitimacy as an institutional asset class. Solana processed $650 billion in stablecoin transactions during February 2026, the highest monthly volume ever recorded on any blockchain, more than doubling the previous peak. The milestone marks a decisive shift in how the network is being used. Where Solana was once defined by meme coin speculation, it's increasingly being used for practical money movement, fast, cheap, high-frequency transfers that accumulate volume even when individual transaction sizes are small. Low fees are the primary driver. On Solana, transfers that would be economically unviable on Ethereum become routine. Standard Chartered has previously highlighted this cost structure as a key advantage for payment-focused use cases. Solana now holds the fourth largest stablecoin supply globally and ranks second in USDC circulation behind Ethereum. That said, Ethereum still dominates tokenized real-world assets, with $15.5 billion on-chain in February compared to Solana's $2 billion. The gap reflects Ethereum's strength in higher-value institutional finance, bonds, real estate structured products. Solana's February data suggests the network is carving out a distinct lane, retail payments and high-frequency settlement, rather than competing head-to-head with Ethereum on institutional infrastructure. That's your Swap Hunt Daily News for March 6, 2026. If this kept you informed, subscribe to Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.